Hi, Mike Almala, recovering CPA, with this next lesson in a mercifully brief introduction to financial accounting. In the previous two lessons, I introduced the rules for recording transactions. Every example of a transaction included in those lessons involved increases or decreases in cash. In this lesson, I consider whether it is possible to accurately assess how a business performed if only cash transactions are recorded in the general ledger. The answer, of course, depends upon the nature of the business, but generally recording only cash exchanges will lead to problems in measuring economic performance. An example will illustrate these difficulties. Suppose you are the bookkeeper for joint ventures, the delivery business introduced in the last chapter. As bookkeeper, you record all transactions based upon entries you find in the company's checkbook register for the month of December. Let's say the December checkbook has only 2 entries. Now, based on this register, you record the 2 transactions in the general journal and then post the appropriate accounts. The owner, Jimmy Morrison, wants you to prepare an income statement for the month of December. Since there is only 1 income item and 1 expense item, your income statement looks like this. Now, Jimmy looks at this financial statement and says, "Bummer." And he gazes intently at the statement and says, "Whoa, man, you must be smoking too much of the product I delivered because I had a way better month than your statement indicates. I mean, I did a $50,000 delivery for the Colombian Growers Co-op. The $5,000 deposit you're seeing in December was just the upfront fee. I made the delivery in December, and they paid me the $45,000 balance at the beginning of January. But I earned the whole fee in December because that's when I made the delivery. And for another thing, that $9,000 payment to Hertz is for 3 months plane rental. Those buggers make me pay 3 months in advance. The way I figure, only $3,000 should count against December, and the rest should go against January and February. It seems to me I really earned $47,000 rather than lost $4,000. Now, you as bookkeeper say, "Look, I only went by the checkbook, and it says you took in only $5,000 in cash revenue and spent $9,000 in cash expenses. Looking at cash, you were down $4,000 for the month. And besides, it will all even out over a long enough period of time." So Jimmy says, "Well, yeah, I can see your point, but what if I want a more accurate picture of what actually happened in December? I'm interested in the long run, but I also want to know what happened in the most recent month because I want to respond quickly to any good or bad trends that might be showing up in the numbers. Not that my reflexes are that good, but no offense, that statement you gave me does not reflect what really happened in December." So what does Jim mean by asking you for a more accurate picture? He intuitively knows there is a natural and logical causal relationship between revenue and the expenses it takes to generate that revenue. Now, the attempt to capture this causal relationship between revenue and expense is called the matching concept. By this matching concept, Jim realized that he really earned $50,000 in fees in December and incurred only $3,000 in expenses. He knew that recording only cash transactions distorted this economic reality. So to remedy the problem, accountants have mandated the use of accrual accounting. In accrual accounting, a business records revenue when the earning process is complete, not necessarily when cash is received. And expenses are recorded when the business receives goods and services, not necessarily when the business actually pays for them. Now, in contrast, a business that records revenue only when cash is received and expenses only when they are paid is said to be on the cash basis of accounting. Now, an obvious advantage of cash basis over accrual basis is that it is much simpler. An accrual system requires more accounts, including accounts receivable, accounts payable, inventory, prepaid expenses, and deferred revenue. Each of these accrual accounts requires making estimates and sometimes complex computations. As in machinery, the more moving parts, the more potential problems. Now, the cash basis accounting approach requires no complex measurements or estimates. An expense is recognized only when a vendor is paid for a product or service. Revenue is recorded only when a customer or client pays for products sold or services rendered. The disadvantage of the cash basis system is that for any particular short period of time, operating results can be greatly distorted from economic reality. Distortion usually results from transactions occurring near the end of accounting periods. So does cash basis accounting always yield different operating results from accrual accounting? Well, no. If most of a firm's sales are cash sales and most expenses are paid immediately, there's little difference between the measured operating results using a cash basis versus an accrual basis of accounting. However, if a business extends credit to customers, has credit extended to it, or carries significant amounts of inventory, the differences in reporting operating results using the two approaches can be significant. For many businesses, cash collections may lag behind earnings by 2 to 3 months. Payments on expenses may also lag as much as 60 days from the receipt of goods and services. In these cases, cash basis earnings may greatly differ from accrual basis earnings. Over the entire life cycle of a business, cumulative operating results are the same under both bases of accounting. And in fact, year to year, the differences may not be that great if the level of revenue and expense remains stable and collection and payment cycles do not fluctuate. The greatest variation between accrual and cash basis accounting tends to occur in the initial and ending periods of a firm's life cycle or during periods of significant growth or decline. Short-term monthly and quarterly reportings can also be greatly different. We saw that in the example. As our friend Jim indicated, accurate short-term reporting is very important in managing a business. In the following lessons, I will consider in more detail the complexity associated with accrual accounting. So click here for the next video lesson.